E ngā mana, e ngā reo, e ngā haui whā. Tēnā koutou, tēnā koutou, tēnā koutou katoa. Me karakia tātou. Tēnei te reo, kia whakapai ai te rā, kei mua i te aroaro, hui e, tai ki e. The karakia talks about making the day right before our gaze. In other words, what's in front of us today? And I tell you what's in front of us today. It is the first online session of Day 2, The Point 2022. Thank you for joining us today, and thank you also for joining us yesterday for what was a sensational Day 1 of The Point 2022. I hope everyone found yesterday insightful, as I did certainly, and the fact that we are here today looking, I'm sure that you'll get some more insights during the day. Thank you again to our sponsors for making the Point 2022 possible. Really great to have all that support across the industry for what is a premier industry event. So before we get started, our speaker today, Anna, will be taking questions. So if you do have any questions, please put them onto the platform, and then we will go through the Q&A at the end of the session itself. We've probably got about 5 to 10 minutes of questions, so don't be shy, put them through, and we'll make sure that you are heard. So firstly, I'd like to introduce Anna Perera-Shaw. Welcome, Anna. Anna is the Director, Consumer Credit Deposits and Payments for Global Data-Driven Strategic Insights Provider of RFI Global. Now, that must be one of the biggest business cards you would ever see. Anna joined RFI in 2016, working in the research team, conducting quantitative and qualitative analysis to answer key business questions for clients. As Director, Anna presents RFI research to clients across a range of topics, providing actionable insights and highlights drivers of consumer satisfaction, advocacy and loyalty, and providing tailored recommendations to assist those clients. Anna also has a personal passion for financial inclusion and resilience, and some of those statistics and data will be shown as we go through today. So for today, the consumers can use a wide range of payment methods, from credit to debit cards, to mobile wallets and cryptocurrencies. Now, this shift has been driven in part by the changing consumer preferences, but it also has been spurred on by advances in technological advances and also sociological, and things like a pandemic. Those have featured into it as well. So now I'd like to hand over to Anna to take you through the research that they have undertaken. Thank you for joining us today, Anna. It's great that you're here.
Thanks for having me.
Really look forward to hearing your insights, and I'll come back later on with some Q&As.
Great. Well, thanks everyone for listening today and for being part of this session. I'm excited to be starting this, the online day, Day 2, with some payments trends in a changing landscape is what we've called this session. But I think there'll be some insights that I think marry quite nicely with some of the data that was shared yesterday, particularly in that final session, the Economist session. And I'll talk you through a few topics to do with the changing landscape, consumer sentiment, and also the future opportunities that travel provides. And just a quick bit of background for those of you who may not be familiar with RFI Global. So as the name suggests, we're a global market research firm, but we specialise exclusively in financial services. So we don't operate in the food and beverage space. We don't research anything that's not to do with banking, and our clients are banks, financial services, tech companies, non-banks, lenders, buy now, pay later providers. Anything that's financial services, we usually have some kind of conversation, some sort of project going on, and it's something that everyone at RFI is incredibly passionate about. We have surveys open in 48 international markets. So what that means is, at any point in time, we have surveys being asked we have questions being asked to consumers in a range of countries. So if you've got a question about, credit card use in a certain country, we probably do have stats for that. And tying that specifically with New Zealand, we've been running research in New Zealand for about 10 years now. So we've got quite a breadth of data as well, which gives us the ability to look, not just pre-pandemic, but also the last 5-10 years, to really think about how is consumer behaviour changing, what are consumers trying to do, how do they want to pay, what are they looking for. So 3 key questions that I'll be looking to address today is: to what extent has consumer sentiment shifted over time? How have consumer payment types changed over time? And what opportunities does travel opening up pose for the market? So hopefully there's a few data points here that are interesting to you, but also get you thinking about what do customers need in the retail banking sector? How can we support customers better? what are they looking for when they seek out banking products, and how are they making payments, and what's their preference, particularly when thinking about travel. Is the way they're making payments the same in New Zealand compared to internationally as well? Now, the research programs that this data that I'll be sharing with you today comes from is the New Zealand Savings and Deposits Council, the New Zealand Payments Program, and the New Zealand Mortgages Council. The data is representative of banked consumers, so consumers with a bank account, and we do make sure this data is representative according to age, gender and region. So we're confident that this is representative of the average New Zealander, and I'll be mostly taking research from the New Zealand Payments Program, which speaks to over 2,000 consumers. Now, the first question, to what extent has consumer sentiment shifted over time? I'll show you a data point, which is one of the few data points I'll show you that's not RFI data. This is external data that many of you would be familiar with. But just to make the point that consumer confidence has fallen, and it's very sensitive. It moves, it's receptive to the market, and we've seen from 2021 onwards it's been falling quite consistently, and this is similar to what we see in Australia with our consumer sentiment index, which is very similar. And we see consumers they're sensitive to what's happening around them. They're aware of market movements, even if they don't always understand what it means. They are noticing these components, and they are aware. So the cash rate has been rising, which we've also included on the chart there. And you can see there's that crossover point with the cash rate rising and consumer confidence falling. The next slide I'll show you this is RFI data, and this is one of the few slides I'll show you that is looking at current New Zealanders who hold a mortgage. So most of what I'll show you is nationally representative consumers, but this is looking specifically at the mortgage holding cohort. And on the left-hand side, you can see the chart the option with a box around it draws your attention to the fact that 1 in 2 borrowers indicates a high level of concern about inflation and the cost of living rising. So on a scale of 1 to 5, they've selected 5 out of 5, which is a really high result. And when you group together those who said 4 out of 5, so somewhat concerned, you can see it's nearly 3 and 4 indicating that they are at least somewhat concerned about inflation and the cost of living rising. And this is something we'll see as I go on through this presentation today, has some flow-on effects with how customers are intending to make payments, how they're spending, what they're using to make payments, and it's something that consumers are really feeling, and something that is definitely front of mind. And I'm also quite confident that if we were to look at, if we ask the same question of those without a mortgage, it'd be quite comparable. The other slide to make note of, the other data point here is just the concern about interest rates rising. We see 1 in 3 mortgage holders indicating concern about this, 1 in 10 being highly concerned about unemployment rates. And I guess the point to think about here is just consumers are increasingly concerned about what's happening around them and the implications of this on their financial situation. The other way to look at this is just by region, and the point that I'll quickly make here is that those living in Auckland are more likely to indicate concern, particularly about rates rising, unemployment rates, and the CCCFA regulations that were introduced at the end of last year. When we look at inflation and the cost of living rising, however, we do see that this is quite comparable for those living in Auckland versus the rest of the market. Now, on my favourite topic, which is financial wellness, we've included, I'll show you a couple of these slides, and then I know that you're probably itching to get into the payments data, but I wanted to include a few of these just to think about consumer sentiment and financial wellness tying in with how customers make payments, how they save their money, how they're making decisions about their banking products as well. And we asked the question, which is, to what extent do you agree with the statement, I am at an optimal level of financial wellness? And I appreciate that this is subjective. What I think of as financial wellness might be quite different to someone else, presumably. But what we've defined this as is how you manage your expenses, how you budget, and how you assess your financial position. So we've kind of framed it as how healthy the consumer thinks their finances are. And here we're looking at all consumers, so the nationally representative view, and it's by age. And what caught my eye first of all is that those aged 55 plus have the highest proportion saying they strongly agree they're at an optimal level of financial wellness. So whether that's because they've reduced debt, they've paid off their home, or they're close to paying off their home, they've got an amount of savings that they're comfortable with. There's a few different components that could be driving that, but we do see that those aged 55 plus are more likely to indicate they are at an optimal level of financial wellness. Going along to the left, you can see that younger consumers are less likely to agree they're at an optimal level of financial wellness. We do see more in that orange category as well of disagreeing with this statement. So those aged 18 to 44, slightly higher likelihood of disagreeing compared to those aged 55 plus. Though there is an interesting result there for those aged 45 to 54, which seems to be a bit more polarised with the proportion who are really agreeing that they're at an optimal level of financial wellness versus those who are disagreeing. And the question that often comes up is, how is this different by income? And there is clearly a relationship with income and financial wellness. You can see we've had an arrow there that as someone's income goes up, or as we look at consumers with a higher income, they're more likely to agree that they're at an optimal level of financial wellness. Those with an income particularly under $30,000 are more likely to strongly disagree that they're at an optimal level of financial wellness. But the point that I really want to make here is having a high income does not guarantee financial wellness. So typically when your income increases, your lifestyle will adapt. It doesn't necessarily mean that you spend exactly the same way as your income increases. And we can't say that if everyone had a higher income, financial wellness would be fantastic across the country, because it's just not true. And if we look at those in that high income bracket of even 100,000 or more, 125 or more, you can see there's still a proportion of consumers strongly disagreeing that they're at an optimal level of financial wellness. So not as many as those in the lower income bracket. Having more money coming in certainly does help, but it doesn't guarantee your financial wellness. And that's the point that I just wanted to make when thinking about what relationship there is with age, but also income and financial wellness. The other data point that I quite like is thinking about financial literacy. So again, this is subjective. This is we ask consumers to self-score on a scale of 1 to 5. They are either agreeing, I have a low level of understanding about banking and finance, or I have a high level of understanding about banking and finance. And again, what I think is a high level of understanding may be different to the next person, but it's important what the consumer thinks their understanding is, because what we see here is those who strongly agree they're at an optimal level of financial wellness, over half indicate they have a high level of understanding about banking and finance. So is that because they're slightly older, slightly more affluent? It's likely, but also I think it's just worth thinking about when I feel that I understand how to manage my money, when I understand the landscape, the products that are available to me, I'm more likely to think that I'm actually able to manage my money. My financial wellness is at a more optimal level than someone who feels they really don't understand banking, they don't understand finances. And we know with financial wellness in particular, there's quite a sizable proportion of consumers who don't even like to check their bank balances. They avoid looking at that number because it's stressful and, it doesn't bring them joy to look at that bank balance. So that's just something to think about as well. And these statements are basically breaking this down a little bit further when we look at financial wellness. On the left, we've got some statements about sentiment towards banks. On the right are some statements about financial wellness. And I'll start on the left with the sentiment towards banks. In the blue is consumers who strongly agree they're at an optimal level of financial wellness. They are more likely to say they want to bank with an institution that is financially sound and that my bank must have smart digital solutions. Whereas those who disagree that they're at an optimal level, less likely to say this is important to them. So they're not as concerned about the bank being financially sound, though it's still important, and they're not as interested in having smart digital solutions, though it is still important, just not as much as that consumer who feels they're at that optimal level of financial wellness. The other two data points that really caught my eye is the one that's fourth from the left. So I'm managing to save away a little each week or month. We see 1 in 4 consumers who disagree they're at an optimal level of financial wellness, saying they manage to save each week or month, so suggesting that this is quite a key relationship with financial wellness, whether or not you're able to put away funds each week or month, or if you're really, every paycheck you get, you're using the bulk of it. The other point is on the right-hand side, so the proportion saying, I often find myself worrying about having enough money to live, which I think also speaks to their ability to save each week or month. We see close to 90% of those consumers who disagree they're at an optimal level of financial wellness, saying that they often find themselves worrying about having enough money to live. So this is just breaking that down a little bit further in terms of what's driving financial wellness and how are those consumers behaving and what's their sentiment as well. Something that was mentioned in some of the sessions yesterday, particularly that final session, was the proportion of consumers using savings and dipping into those excess funds. And what we can see here is under 35-year-olds are more likely to have used savings in the last month or the last 2 to 3 months to fund their lifestyle. Across the market, we see 2 in 3 having dipped into their savings to fund their lifestyle in the last 12 months. And when we ask why did consumers dip into their savings accounts, it's typically to fund general household expenses or unexpected expenses. Some consumers are also using savings to fund travel or holiday or home renovations or furnishing, but I do think it's really interesting that the top 2 reasons for dipping into savings is general household expenses or unexpected expenses. And we know consumers are concerned about cost of living. They're finding things to be more expensive, which is valid as that's what's happening. And they're using savings to fund their lifestyle, but not discretionary lifestyle. It's more so just to fund the household and unexpected expenses that come up. And now this slide is just looking at, in the next 12 months, what are consumers likely to do? And you can see I've added a couple of statements at the bottom just to tell the story a little bit, but essentially consumers are planning to spend less, save more, and borrow less. So we're looking at this trend in terms of how, what consumers are likely to do, and there is a growing proportion of consumers who are intending to save more. There is an aim to reduce spend, though I appreciate that when you look at external data, spend does change, but it's that intention that I think is really important. Whether or not this amounts to actual reduction in spend, it's important to think about the fact that consumers are trying to spend less, they're trying to reduce their borrowing. Where possible, they're trying to save, though we know that when they're dipping into savings, they're spending it on household expenses, unexpected expenses, but the intention is there. So I think it's useful when thinking about how can banks or financial service providers help customers, thinking about how consumers do want to save more, they do want to reduce their spend, they do want to borrow less. So something that we've seen, particularly in the last 2 years, really become quite a strong story. Now the topic that I think everyone has probably been waiting for is payment types and these trends over time. And the first one I think is a really good indication of some movements we've seen, and we've only included data from the last 4 years just to keep it really simple, but the key point that catches my eye is between 2019 and 2022, the proportion of consumers indicating they use a Visa or MasterCard debit card in a typical month has increased. So increased particularly in May 2020, declined slightly and then continued to increase. So if you were to draw a line from 2019 to 2022, it's a consistent, it's growth. So from about 48% to 53%. We've seen a decline in consumers indicating they use an EFTPOS or ATM card in a typical month. Interestingly, the use of credit cards remains reasonably consistent, though having fallen just slightly from 2020, and the proportion having used cash in a typical month or saying they use cash in a typical month has fallen. And the point to make with cash there is you'll notice it's not a perfectly downward trend. It drops dramatically in May 2020 when consumers were not really able to use cash, or there was really strong encouragement to not use cash. And then it rebounded slightly where we saw a bit of an increase, but it continued down that downward trajectory. So it's just showing that although in May 20 we saw some more dramatic results, we had a bit more recovery in 2021, and then 2022 really showed that the longer term trend away from using cash. So cash, it's still, depending on how you look at this, 42% of consumers indicating they use cash in a typical month is still quite high. It's not 4%, it's still, that's 2 in 5 consumers saying they use cash in a typical month. So it's still playing a role for some consumers, and that was covered really well in some of the sessions yesterday about the role of cash, particularly for consumers who need it to fund their lifestyle, particularly older New Zealanders or customers who just find that to be a little bit easier. But cash has been declining, though it's one we'll be keeping a close eye on. And then the final point just to make is that buy now, pay later service option on the far right. We've seen consistent growth in consumers indicating they use buy now, pay later in a typical month. And I do have a couple of slides coming up just showing buy now, pay later more specifically, but just to give you a bit of a taster of that one, we've just seen that increase over time, so will be something that I'll cover in greater detail coming up as well. There is an age relationship here as well. If I start with buy now, pay later, you can see that buy now, pay later is typical monthly use of buy now, pay later is likely to be 18 to 44-year-olds, particularly 18 to 34-year-olds. Credit cards skewing for an older consumer, particularly those aged 45 plus. Cash skewing for the 55 plus cohort. Visa, MasterCard, debit cards skewing for the under 35s. So there are some really clear age skews evident here which do inform the trend. So on that previous slide, if I showed that to you filtered for just 18 to 24-year-olds, it'd be a very different chart. So worth thinking about when we talk about these changes over time. Age groups, the demographic does play a role, and consumers of today are different to what they were 5 years ago, 10 years ago, 20 years ago, and it does change quite quickly as well. If we look specifically at cards, so which cards are being used most frequently by consumers, 18 to 24-year-olds are most likely, very, very likely compared to all other age groups, to say their most used card is a scheme debit card. 25 to 34-year-olds, over half saying a scheme debit card is their most used payment or their most used card, less likely to be credit card. But then you can see for those aged 45 plus, 55 plus, the gap gets a little bit closer between the proportion who prefer to use a debit card or use the debit card most frequently or use a credit card most frequently. And the other point to make is just that right-hand chart showing the trend over time. There's been growth in consumers saying they use a scheme debit card as their most frequent card type, and the proportion saying they use a credit card dropped slightly, and then it's remained at just under 1 in 3 consistently over the last 3 years. So when looking at cards, debit really gaining traction among the younger cohort. Then if we think about credit cards specifically, it is something that we've had a lot of discussion about the role of credit as a necessity, credit to help fund more expensive, as expenses become more pricey, using credit to help service those expenses or manage cash flow. There's still a key role that credit plays. And here on the left, that line chart is showing the proportion of consumers who intend to apply for a credit card in the next 12 months. It does move over time. It's about just under 1 in 10 indicating they're planning to take out a credit card in the next 12 months. So we know consumers are planning to borrow less, but it doesn't mean that intention to take out a credit card has completely fallen off. It's still prevalent. It does move over time. If you were to draw a line from 2018 to 2022, it would actually be a straight line if you kind of ignore the fluctuations there. But I think the interesting thing to think about is the types of cards that consumers are likely to apply for, because I see that there's two key groups that emerge, which is the consumer who's intending to take out a rewards earning credit card versus the consumer who's intending to take out a low rate card. So taking out a low rate card that you potentially expect to revolve a balance on, compared to I'm going to take out a credit card because travel's opening up, I can earn Qantas points, I'm able to start to build up rewards or the airline benefits from getting that type of reward, or even other rewards cards that just enable them to get cash back or rewards. So I sort of see that there's two groups emerging in that new pool of prospective credit card holders, with those who want to earn rewards versus those who are looking to use credit to fund their lives and look for the cheapest or lowest rate or low fee option there is. The next point on credit cards is when thinking about why consumers chose their most used credit card. There's the point that I'll be making a little bit later on, but I'll make it here as well, is just that merchant acceptance is important, but it isn't the key reason customers are choosing credit cards to the extent that it was 10 years ago. So 3 in 4 cardholders 10 years ago who took out a credit card said they did so because it was accepted by merchants, whereas now it's not as much of a driver of choice. It's still important. It's declined dramatically over the last 10 years, but it is still important. But we've seen growth in consumers saying they took out a credit card because it had a low or no annual fee, or it had low interest rates on purchases, which I think just speaks to, again, credit being used to help fund the lifestyle, and it's serving a particular need around helping with cash flow and trying to reduce building up excess interest costs or fees where possible. And then the point that is interesting is how consumers or how credit card holders manage their balance. So 18 to 34-year-olds, you see 1 in 3 indicating they're a low revolver, and what that means is they sometimes just pay the minimum rather than the full balance, and then they sometimes pay the full balance. The high revolvers are in that darker orange, and you can see that 45 to 54-year-olds are more likely to be in that high revolving category compared to the younger cohort. So they're revolving a balance every month. So they're really, relying on that product, and, they're potentially not able to pay that debt off just yet. And then across the market, you can see that older consumers more likely to be paying their balance in full. So they're in that transactor category. The interesting point that surprised me a little bit was between May 2021 and May 2022, where we've seen the proportion of revolvers remain fairly consistent over time. It doesn't seem that the last 12 months, with things becoming more expensive, it's meant that people are really jumping into revolving territory, but it may mean that consumers are still trying to reduce debt where possible, and potentially just trying to avoid revolving as much as possible, or they've already revolved a balance, and that's kind of where they are. But we don't necessarily see a new cohort of balance revolvers just yet. And then something that ties in with payment methods is how the payments are being made. So contactless versus non-contactless transactions. This is the last slide I'll show you that's not from RFI, but basically just to reinforce that contactless transactions as a proportion of total card spend have continued to increase. There was that dramatic increase in May 2020 with the pandemic, but it's continued, dropped slightly and then continued on an upward trajectory there. But to get back into the RFI data, you can see that when we ask consumers how often do you make contactless payments, so tap to pay payments using a card, the dotted line is showing anyone who has used contactless, and then the dotted blue line on the bottom is showing the consumers who've used contactless more than once a week. And the first point I'll make is the darker dotted line at the top. Between May 2019 and May 2020, we saw that proportion having used contactless ever increase 12%, and that's continued to increase slightly, though not a lot. So it seems that there might be a point in which this reaches saturation, where all the consumers who have the ability to make a contactless card purchase have at least tried it once. But the interesting data point that I think is a bit more compelling is the bottom one with that bottom dotted line, which shows that between May 2019 and May 2020, the proportion having made a contactless payment more than once a week has gone up from 25 to 40%. It then went up to 51%, then up to 64%. So this is it's a fairly sizable increase for quite a short period of time. In Australia, we've been tracking contactless for a number of years, and we did not see this much growth in that short of a time period. So this is really speaking to something that consumers adapted to during the pandemic, and something that's carried on post-pandemic. So I started trying contactless payments in the pandemic, and I actually realized that this is quite convenient to me. So something else interesting there. And the other thing that I think really speaks to the merchant acceptance point is the proportion of consumers who agree they can tap and pay with a contactless card at all or most shops they visit. So in 2019, 41% indicated that they can tap and pay with a contactless card at most places they go. That increased to 47% in May 2020, it's 53% in May 2021, and 60% in May 2022. And I don't expect this proportion to fall. If anything, I expect it to increase. So consumers valuing the ability to tap their card to make a payment, expecting this to a greater extent, and seeing it become more prevalent, and something that it could mean that there becomes a friction point where they go to make a contactless payment and they can't, and it's becomes frustrating when before they didn't even think about it, because people adapt to a new way of paying quite quickly, and when they're not able to use it, it can then provide a potential pain point. So this is just an interesting one to think about when thinking about contactless as well. Mobile payments is the other element to the contactless story. So just thinking about proportion of this is looking specifically at iPhone owners, just to think about that cohort of consumers with an iPhone and their likelihood of using Apple Pay. We see close to 9 in 10 saying they're aware of Apple Pay, and the proportion having used Apple Pay has increased again in quite a short period of time, very similar to what we saw with contactless card usage. So between May 2020 and May 2022, it went from 29% to 54%. So again, short period of time, quite rapid growth in usage of Apple Pay. There is an age element here, and now we're looking at both Google Pay and Apple Pay. You could see under 44-year-olds are most likely to be aware of mobile payment services, but those aged 18 to 24 are the group most likely to have made a mobile payment, followed by those aged 25 to 34. But I think the point to make here is mobile payments aren't exclusively a millennial payment tool. It's not something that only 18 to 24-year-olds are using. It's not only something the youngest demographic are using. There's over 1 in 10 age 55 plus who have used mobile payments, 1 in 4 of the 45 to 54 age cohort, and I expect to see this to increase as well. You know, it's something that really resonates with the younger consumer, but it's not an exclusively younger tool, and it's something that does add value to a lot of people who have tried this for the first time and continue to use it going forward. When thinking about what the barriers are to mobile payments, I won't spend too much time here, but just thinking about on the left, we see non-mobile payment users are most likely to have not, or to say that what's preventing them is they don't feel a need to make payments this way. I think this barrier can be addressed. I'm an optimist, but if consumers see the benefit, if they try it, if they see that it's convenient, I think that they can change that perception of not needing to make payments this way. But the other three that I've added that red box to the top of, you can see I don't think mobile payments are secure. I don't know how to make a mobile payment. I don't think mobile payments are reliable. I think all of these are addressable with consumer education. So let them know that it's actually more secure than using a plastic card. Let them know how to make a mobile payment. Let them know that it is reliable. Let them know what to do if something goes wrong. You know, I think that barriers to mobile payment use can definitely be addressed, and even that final one, mobile payments aren't accepted everywhere, that's become less of a key reason why customers aren't making mobile payments. So they expect that they're knowing to a greater extent they can make payments this way, but the barriers are more about the security and reliability, or even just knowledge of how to do it. And then on the right-hand side, those who have made mobile payments before but don't do this regularly, again, less likely to be an acceptance barrier, more so that perception of security or reliability, or a lack of perceived need, which again I think can be adapted to with more frequent use and mitigating some of those concerns about security and reliability. Buy now, pay later is also another topic to quickly cover off. We did see that the proportion of consumers using buy now, pay later in a typical month has increased year on year over the last 4 years. We've seen that 86% of consumers in New Zealand are aware of at least one named buy now, pay later service. We see 1 in 3 having actually used a buy now, pay later service before. And if you look at the box on the left-hand side, there's an age skew here where under 35-year-olds are most likely to have used a buy now, pay later service. However, as we saw with mobile payments, there are 55 plus, 65 plus consumers who are using buy now, pay later services as well. And usually it depends on the service. We see in Australia at least that the lower value retail purchases are typically made by a younger customer, whereas when it's something that maybe buying a washing machine or something that's big ticket one-off purchase, buy now, pay later does provide quite a useful need, or for things like dentist appointments or those sort of purchases where buy now, pay later just helps them defer the cost. And I think something here that speaks to why consumers are using buy now, pay later is previously we used to see that key drivers of use of buy now, pay later services were wanting to give it a try. So we call that sort of the curiosity factor. I just wanted to see what it was like. It was offered to me at checkout. But what we see is consumers, the key reason customers tried or used Afterpay or other services was not having to pay in full upfront when they could make better use of their money, or not being charged interest. So they're using it to a greater extent as a budgeting tool, more so than just trying it, just giving it a go. It's really servicing the need that customers have to reduce paying interest and make better use of their money and help them budget. So that's, I think, an interesting change that we've seen in the market as well. And the other question we do get asked is, to what extent is credit cards, are credit cards being used by buy now, pay later users versus non-buy now, pay later users? And the point just to make here is that buy now, pay later users using a credit card, although it's fallen slightly, it's still over 1 in 3 buy now, pay later users who use a credit card in a typical month. There are 1 in 3 in that cohort. So it's definitely, there's still that cohort that exists. And then my final few slides today is just thinking about travel. I'll go quite quickly through these in case there's a couple of questions that I can address. But when asking consumers when do you next intend to travel internationally? We see 1 in 3 intending to travel in the next 6 to 12 months, 3 in 4 intending to travel in the next 2 to 3 years. So quite a high proportion of New Zealanders intending to go overseas in the next at least 12 months, or in the next 2 to 3 years. We've seen people start to travel. I think it helps when more and more people travel. It feels a bit more normal, but there is quite a high intention to travel internationally, particularly among under 44-year-olds. We see under 18 to 34-year-olds are most likely to intend to travel compared to the older consumers. And when we look at the data here, consumers who intend to travel, typically a bit younger, as I said, also more likely to have a slightly higher income and to hold a credit card. So it might be the customers who've saved a bit of money and they feel that travel is a priority for them, whereas others, with cost of living and everything, it's potentially not as much of a priority to them. The other point to make is, I might skip ahead to this one, when looking at different payment categories, flights, accommodation and emergency expenses are most likely to be funded using a credit card, particularly given they're a bit more expensive. We see food while travelling, a bit more of a closer split between intention to use cash or credit cards, and looking at retail or shopping while travelling, credit card being the preference, followed by a scheme debit. And I'll show you that slide and I'll show you a domestic comparison as well, which I think is interesting. But intention to travel domestically, we do see this proportion much higher. So 3 in 4 intend to travel domestically, i.e. within New Zealand in the next 6 to 12 months, 9 in 10 intending to do this in the next 2 to 3 years. And when they're intending to make payments in New Zealand, it's most likely to be using a credit card or a debit card. And the comparison here with that previous one, I know I've sort of raced through it, but basically the interesting thing here is that there's a closer gap between proportion of customers expecting to use a credit card on their domestic trip compared to a scheme debit card, particularly for tours, food while travelling, shopping, attractions. So there's a greater intention to use credit while overseas, but when looking at domestic travel, debit is still one of the key reasons or the key payment types consumers plan to use, which is in line with what we see in typical monthly payment methods being used as well. So just to wrap that up, I know it's been a lot of data. Hopefully it's been digestible and I haven't gone too quickly, but I think there's 4 key points that I'd like to leave you with. The first is that consumers are concerned about inflation and the rising cost of living, which feels intuitive, but I think it sometimes helps to just have a visual to really see that that's something consumers are thinking about. And we see that there's real opportunity to improve the proportion of consumers feeling that they're at an optimal level of financial wellness, particularly given consumers are trying to reduce spend, borrow less, save more money. They're trying to save money to a greater extent, and I think there's opportunity to support customers in that space. In terms of payment trends, we've seen debit really gain traction and use of cash has fallen. Buy now, pay later service usage has also increased, and they're being used to a greater extent for budgeting support, so maximising cash flow, avoidance of interest and helping them budget. We did also see that customers were using credit cards, looking for low rate credit cards as well. So just speaking to that need for low cost solutions. And we've also seen contactless payment methods having increased. And then the final point there is that consumers are becoming more comfortable with travel, particularly that younger demographic who are the most likely to intend to travel. And credit card is the predominant payment method consumers intend to use while overseas, particularly for the more expensive purchases like flights and accommodation. And if consumers are going to use cash, it's typically for a smaller purchase, but it's quite a low proportion. So that brings me to the end of my slides there. I'm happy to answer any questions if there are any.
Yeah, there certainly are, Anna. There's been a couple of questions coming through. So firstly, thank you for those insights and what was quite a tsunami of information, but hopefully everyone's been able to digest that and think that through. One question I have just to kick it off is, do you think consumers have a higher or lower financial literacy than they actually indicate?
It's a good question, and I think we sometimes talk about consumer overconfidence with someone thinking that they're really aware of how to pay for expenses and that self-score. But I do think at a general level, I think people underestimate. I think that we're not thinking about financial literacy testing. It's just more that understanding of products available to them. But I do think there always is a need for banks to provide really clear information. I think particularly the last few years we've seen consumers want transparent information about pricing. They want clear and really easy to understand information. And we often see that pain points, particularly in the credit space, is do I feel that I understand my product? Not necessarily. So you go through that home loan application and at the end you think, what is this? What am I doing? And I think that's where consumers do value that extra support, and just helping break down, for the people that aren't in the banking space like we are, where it kind of makes sense to us, but the average consumer, I think, doesn't understand it as much as we may like.
So that underestimation or denial is more about a core misunderstanding about financial products and services.
There's probably a lack of interest as well. I think we all love banking, but I think that it's not something consumers actively seek information about. And I think especially if we think about money is not always comfortable to talk about or to ask questions about. So am I going to actively seek out information about reducing my credit card debt, or am I going to hope that it sort of just goes away and I don't have to think about it?
Right.
I think there's that element of financial stress that plays a role.
Gotcha. And what is it about debit cards that appeals to the younger consumers so much? It's a really interesting insight, that one.
I think something that 5 or 10 years ago, maybe 10 or 15 years ago, you'd turn 18, you'd get a credit card, and credit cards gave you that ability to, especially more recently, buy online, and it was something that we saw that was the stepping stone for making payments in a more diverse way. Whereas debit cards have the exact same functionality. You can use contactless, you can buy online. I think they're easy to use, and they don't. There's no credit check as well. So I think it's just the ease, the ability to use the product, but also just the functionality. There's not a lot of difference between what you can do with a credit card and a debit card, apart from the fact that you're using your money versus credit.
Yeah. Here's a really interesting question that's just come through, so thank you for sending that through. We hear a lot about new payment methods, like digital wallets, mobile, etc. So how are we addressing inclusion for those with impairments or gifts such as deaf, visually impaired, neurodiverse, etc.? Is that something that comes through in the research?
It's a really good question, and it's something. I have a friend who works in occupational therapy, and she's told me quite passionately that banking apps just aren't good enough. That it's, we think about accessibility on a mobile phone. It's certainly gotten better in the last 5 years, but it is really difficult for people who have visual impairments, hearing challenges, and I think it's something that I would need to look more into to find out specifically what banks are offering. But I think in the everyday, there's probably some opportunity to think about how that can be better addressed. But it would depend on the institution. I know that banks do make an effort to make clear that if you need help with translation or making things more accessible, they can help with that. But it's something that I'd need to look into more, but my feeling is that it's something that probably needs a little bit more work.
And more addressed at the institutional level rather than all of industry level?
Yeah, I think it's something that it probably would relate to what the task that a consumer's trying to do. With contactless functionality, potentially there's something we need to think about with the terminals themselves. Are they making a sound that a consumer can hear if they don't have, if their eyesight isn't clear, or there's probably a few questions that we'd really need to be looking into, and I'm sure there are organisations really looking into this to see if that's something that can be worked on. Yeah,
cool. And just another question that's come through, which sort of talks a bit about categorisation of payment types, and it may be more of a research methodology question than a payments one, but it's interesting nevertheless. So why do we continue to refer to buy now, pay later as a payment mechanism when it's a thinly disguised credit facility that's not governed by legislation? And so I wonder whether, there's the type of payment that it is and what the underlying payment transaction occurs on what rails, or is that more about a consumer perception about they refer to it as buy now, pay later, therefore that's what we need to research?
Yeah, that's a really good question. I think basically what you've said is what I would lean towards, where, absolutely correct, where, you're paying, if I'm paying with Afterpay, I'm funding it with my Visa debit card. But consumers are thinking about, I went online, my checkout method was Afterpay, so I've paid with Afterpay. So you're right, it's to help us understand the trend, and it's similar to when you look at mobile payment services alongside, if you look at, say, Apple Pay usage versus credit card and debit. Apple Pay is, that's the service you're using to make the credit card payment, but sometimes it can just be helpful when thinking about how consumers think about it, and they don't necessarily distinguish the two.
Yeah, interesting. Just another one too about the longevity of reward credit cards, in terms of or the low rate credit cards. What do you think's going to dominate? Who's going to have world domination at the end of the day on those two?
I suspect affordability is going to be more important than rewards. I think the last 3 years have made a really profound impact on the rewards landscape. I think rewards propositions have become slightly less compelling, especially in the travel space. I know I used to have a credit card with an annual fee that you could convert to a travel credit, and it just got to a point where I thought, well, I can't travel, this is just a waste of money. So I downgraded to a low rate card, and I suspect customers are looking for the functionality that a credit card can offer, but without that premium cost attached. But it depends. I think if you're a corporate traveller, credit card plays a really important role with the rewards. Or if you're someone who's really savvy, loves to be able to get points to get supermarket gift cards, or I think with the right proposition that can help customers save money, there's appeal. But in terms of 5-10 years ago, when you really had premium rewards card members and that was something they really enjoyed having, I think low rate is going to become more important as customers are just looking to reduce unnecessary spend. And I think annual fees kind of up there with a cost that isn't always justifiable.
Gotcha. And talking about another longevity question, if you like, we had a lot of discussion yesterday on day one around cash and whether it is or isn't going to be around in 10 years' time, 20 years' time. So does the research give us any indication of likelihood of when that becomes like checks here in NZ and it doesn't exist anymore? We're currently in the top 5 cashless societies already, and I know some jurisdictions have had a go at removing it altogether and then it's backfired. So just any indications from the research that are saying how long cash is going to be around, and will we get a new monarch on one of our banknotes?
Yeah, I love the topic about cash. I think it's really important, and I was taking some serious notes yesterday in the session. I think cash plays a really key role, particularly for people with disabilities, people in remote areas, older people, and I think there's people who've been using cash habitually for 40, 50 years. They're still going to be around for decades, and to try and get people to adapt, I think, is quite challenging. But when we ask some research to your question about do we have data that supports this, we ask a question which is, can you imagine a future where there's no cash? And it's something that has been increasing, the proportion of consumers saying, yes, I can imagine that future. There's an age skew, older consumers less likely to agree, which I think speaks to the point about habitual cash usage. I think there was a really good point made by Brett yesterday about if cash is this important, perhaps there's a digital inclusion issue that's happening.
Yes.
And I think that did get me thinking about we need to balance cash still being available for those who need it, but also making sure, to the accessibility point as well, can everyone who needs to make payments, who has a certain need that cash addresses, how can we help them use digital? How can we help them make contactless payments? So I think there's probably, I kind of agree with both sides. You need to make sure cash is still an option for those who really need it, but also make sure that if people are using cash because they can't use other payment methods, what are those reasons? How do we make that easier for them? How do we address those?
Yep. Yeah, interesting. And just from your point of view, what's your favourite payment method?
I would say probably a credit card, but pay my balance in full.
Right, yeah, very good.
Yeah.
So just no other questions have come through at this stage. Look, Anna, we're just about out of question time anyway, so look, thank you so much for your time today. Thank you so much for sharing those insights, as always RFI does in terms of when they present to the industry here. So thank you again, and look forward to seeing the next round and where that's gone to.
Thanks very much for having me.
Yeah, pleasure. Thanks also for everyone who has joined us here today, and I know that you would have found that very useful and informative, and as we also reflect on our own personal preferences around payments. I found it quite surprising that Anna doesn't think people actually think about banking and payments that often, I mean, because it's such an interesting industry, but nevertheless, that's probably the case. Please note that this session has been recorded and that will be available over the coming weeks. We'll let you know when it is available. So no need to worry if you've had to duck out to get a cup of tea and you missed a bit, you can come back and see it as well. Now, we have 5 more online sessions today for the Point 2022. I hope you'll be able to join us for all of them. Now, our next session is with Dave Birch at 10 a.m. So that's roughly 12 minutes away, and it's called Tap to Prove. So when you exit this session, just click into session 2 and you'll get there. So click back in around 10 minutes or so, and we'll see you all again shortly. Thank you so much for joining us.